Just ahead on retirement results, we will tell you why income is much more important than one big nest egg when it comes to your retirement years. Plus, the Social Security cost of living adjustment. Can it keep up with inflation? And we'll test your financial knowledge with another edition of a game we call Right or Wrong. Retirement Results starts right now. Hello and welcome once again to Retirement Results with Ford Stokes. I'm Matt McClure here, joined by Ford. He's our Chief Financial Advisor, CEO of Active Wealth Management. Ford, I'm thrilled to be here and doing Retirement Results with you on the TV.
I'm so excited to be here with you too. It's also great, Matt. You're a former New York One reporter on the floor of the New York Stock Exchange, but you're also a Series 65 licensed advisor, life and health agent. You're licensed to do insurance products, all that stuff. It is so great to not just have a talking head here, but have somebody that's a member of our Active Wealth family is actually hosting this show. Thank you so much for doing this. And also, it's great to have you work with clients in our communities that we serve, and just great to be with you.
And you've been doing Retirement Results on the radio now for quite a while, several years. Talk about the goal now for moving to TV as well.
We just want to educate more folks. Our goal is always to help people protect and grow their hard-earned and hard-saved wealth. We want to do everything we can to build that tax-efficient, fee-efficient, and market-efficient portfolio for folks. And we felt like it was a little bit bigger megaphone by getting on television as well. And it's working out great for us. We're just really excited just to serve more people.
Yeah, that's what it really is all about. And, you know, our more observant viewers might notice behind us here, there is the Forbes Finance Council logo. Tell them what that's all about.
Well, I'm really pleased to be invited to be part of the Forbes Finance Council. I contribute articles each and every month to Forbes.com, and there's millions of people that go there every single day almost. And so really happy to be part of that. We provide articles, but also expert opinions. I'm part of some expert panels regarding retirement, and just shout out to Forbes and Forbes.com. Y'all check us out over there at Forbes.com. You can just search Ford Stokes and you'll find all of my articles and my quotes and everything, all my contributions to the expert panels as well on Forbes.com. And thanks again, Forbes, for including me on the Forbes Finance Council.
And you know, as I said at the very top of the show, we're talking mostly about Social Security today. It's going to be a big part of our discussion. Great topic for you, by the way, because you happen to be a registered Social Security analyst. Tell our viewers what that is and what that means.
Yeah, in addition to being a licensed financial advisor and licensed life and health agent, I'm also a registered Social Security analyst. And that's not associated with Social Security Administration, but I am able to help people maximize their Social Security income benefit and help them with really great Social Security maximization reports that we call an RSSA roadmap. And I'm one of 15 in the state of Georgia and only one of 7 in the state of Alabama. It's a big deal. I'm here to help people, but I'm so glad I went and got that in the past few years to really help our clients better plan, because choosing Social Security is going to be the number 1 or number 2 most important decision people can make in retirement in the United States.
Yeah, and there's a lot that goes into it as well. I'm going to kind of pick your brain here and test your knowledge a little bit about Social Security, because, you know, a lot of people really are worried about it these days. There was a survey, a Gallup poll, that showed about a third of pre-retirees expect the program to be a major source of income in retirement, but 43% expect to see a cut in benefits by the time they retire. Are those concerns founded?
They absolutely are. Unfortunately, the Congressional Budget Office the last 2 years has given us some guidance. Also, Social Security Administration agrees as well. The Old Age Survivors Insurance Trust Fund, the OASI, is going to be depleted 100% by 2033. That's a year earlier than what they told us the year before. So we lost 2 years in 1 year from the Old Age Survivors Insurance Trust Fund. The concern I have is it looks like it's going to be a 23% cut across the board for every Social Security income benefit recipient unless Congress does something about it. I give credit to Senator Tommy Tuberville, who's come out and said, hey, wait a second, we've got to do something about this. But something hasn't been done for decades. Really, the last time they looked at Social Security was during the Reagan years to make sure that Social Security wasn't depleted. Hopefully they'll fix that. But we like to help people build their own personal pension so they can supplement and better plan in case that 23% cut comes right there in 2033. Also, we also help people understand that they can build retirement income when they lose the eventual death of one of their spouses within a marriage as well. So we want to do everything we can to help them navigate those 2,000 plus decision points within Social Security.
Viewers are going to hear us say this a lot, so get prepared for that. But having a steady stream or streams of income, and I'll say that again, stream or streams of income is more important than having a big nest egg for your retirement years. Talk about why that is and why we tell folks that.
Yeah. So first of all, when people come to us, we try to do a retirement income gap analysis for folks. So whether they have a retirement income surplus when they're starting retirement, they're in retirement, or even in advance of retirement. And also sometimes they have a negative retirement income gap, which means they have to withdraw more money from their retirement accounts or their investment accounts, or even their checking, their savings accounts. We want to help plan that in advance. We're really trying to understand that. We want to do everything to make sure that people can stay in advance of their expenses. Income is a very important part of that. You also need to make sure that your nest egg is growing with inflation as well. And we're going to talk about that three-legged stool of retirement right, I think, in the next segment. But you've got to do everything you can to protect and grow your hard-earned and hard-saved assets. Sometimes it's even harder to save the money than it was to earn it, right? Mm-hmm. And we want to build that tax-efficient, fee-efficient, and market-efficient portfolio. And income is really important because we're in that decumulation phase when we're in retirement. When we're working, we're accumulating money. When we are retired, we're decumulating and taking the income from our hard-earned assets that we've got.
And we're going to talk a lot more about all of that and about so much more as we continue with this edition of Retirement Results. We're going to talk about the three-legged stool. Have you heard that term before? If you have, we're going to tell you exactly what it means, because you might have heard it and been like, I don't know exactly what that's all about. So stick around for that. We'll also talk more about Social Security and how you can build your own personal pension. In the meantime, scan the QR code on the screen to get your own results in advance retirement plan from the team at Active Wealth Management. We'll be glad to do that for you. That's why we're here, after all. Stick around. We've got much more retirement results coming up right after this. Welcome back to Retirement Results. I'm Matt McClure here with Ford Stokes, our Chief Financial Advisor. Let's go ahead and share our financial wisdom quote of the week.
Here's our financial wisdom quote of the week.
And this time around, it comes from Earl Nightingale, who was a motivational speaker and an author as well. And he said this, quote, "Never give up on a dream just because of the time it will take to accomplish it. The time will pass anyway." Ford, what's your reaction to that? I think that's great.
I totally agree. I think a lot of people really should have a retirement dream or retirement vision. I kind of overstep my bounds sometimes as an advisor, and I say, hey, do me a favor. I want you to really understand what your vision for retirement is. Number one is I want you to understand who are you with? So with family, friends, things like that. What are you doing? And then also, where are you living? And then the last piece is how are you going to fund it? A lot of people start out retirement they don't really have a plan. They like not going to work. They like not having a boss. That's great. But a lot of people want to do more than just retire. Sometimes they want to relaunch, whether it's start a charity or they want to go and start their own business again and leave the corporate world behind, or whatever that looks like. Whatever your vision for it, great. But you also got to figure out how you're going to fund it. Yeah. And so when I hear Earl Nightingale's quote, it's not too late to dream. It's not too late to plan for that dream. And I would encourage everybody to really look at retirement with a vision in mind. And that's why we do so much results and advanced planning, Matt, where people can really see what the funding looks like for their retirement in like 2 pages in advance. It's pretty neat stuff.
Oh, wow. Yeah, it is. It's like a financial GPS in a way. It's kind of the way I like to think about it is, and that smart vision for your retirement is that destination. Because like, you get in the car, you go to a place you've never been, retirement in this
Right.
case, in the illustration. What is the first thing you do? You put in the destination. So you got to know where you're going. Then you plan out how to get there.
Right.
And that comes to, how you're going to fund it. The main sort of crux of the show today is talking about that very thing, talking about retirement income, securing that retirement income. And, a lot of times people historically anyway have talked about retirement and retirement planning and referred to a three-legged stool. So let's talk about it. I'm sure our viewers have probably heard that term before.
Sure.
What do we mean when we say three-legged stool?
So for us at Active Wealth Management, the three-legged stool for people's retirement are here's the three legs. Number one would be a managed portfolio. Our managed portfolio is kind of our 50-50 setups for allocation between strategic, which means strategic allocation, we're rebalancing once a year, and also tactical, which means that we're rebalancing at least once a month. We're more actively managing the portfolios. That's why the name of our firm is Active Wealth Management, because we don't want to just hang in there with our clients' assets and ride it all the way down to the bottom of the market. We want to reallocate to those allocations and those different asset classes that we think are going to do better over the next 6 to 12 months. And therefore, we try to actively manage and trade within that account. We don't get paid on trades. We only make money when we manage people's money. And as our clients' money grows, our flat fee grows, but we have to absolutely grow our clients' money first if we're going to get paid any more money ourselves. So we're on the same side of the table as our clients, and we always put our clients' needs ahead of our own.
That means a lot. Well, and then the second leg of the three-legged stool would be pensions, right? And people might say, well, I thought pensions had kind of gone the way of the dinosaur. And they really, for the most part have. I think what was it, 13 some odd percent around that number of employers, private employers offer pension plans. So not a lot, used to be a lot more, obviously. So how can people make sure that they have that leg of the stool in place when pensions, by and large, aren't really around?
Yeah, a lot of people don't understand that there's two big things with that. Number one is you can actually build your own personal pension, Matt. And I know you do this all the time with your clients. I do it with mine as well. But we can help build a personal pension with a fixed index annuity. Generally, what we do is we take the income portion of a portfolio and we separate it from the overall portfolio and we invest that into a fixed index annuity and kind of put walls around it. So there's absolutely no way that client can lose their principal. So therefore we're protecting that retirement income portion of the portfolio. Generally it's a 40% of the portfolio. Harry Markowitz in 1952 was given credit for being the founder of modern portfolio theory, which basically states you take 60% stocks and 40% bonds. That'll give you an efficient investment frontier. So what we like to do is take 60% stocks and 40% fixed index annuities, replace the bonds, and get that personal pension. The second thing that's really important for people to understand about the second leg of the stool, sorry for the 2 seconds there, but I will tell you this, is that they can do better than a traditional pension, because a lot of pensions are built with something called a single premium immediate annuity, or a SPIA. We build our portfolios with fixed index annuities that also are tied to an underlying index so you can get market growth. SPIAs, or the traditional pensions, are really good at paying our money back to us. They're not really good at growing our money. Whereas the fixed index annuity, that's index linked, it's linked to the markets, but also your money's 100% not at risk with financial market risk. So that's good. Your principal's protected. But then you can also grow with market-like gains throughout your years, and therefore your income should increase over time. One last point about that second leg of the stool is that they'll give you a 0.1% more each year that you age of your principal or your account value, and therefore that means that your retirement income is increasing over time.
Yeah, it's really great and can give people a lot of peace of mind, knowing that they then, in retirement have that income that they can't outlive. It's, it's grown, it's been protected during the investment and during their working years, that phase of their life. But then in retirement, during the decumulation phase rather than the accumulation phase, it's providing them with that income stream they cannot outlive. Now, the third leg of the stool, so we've got the, managed portfolio, so securities and, stocks, that kind of thing. We've got pensions, which we just talked about, and the way that we do that is annuities. Third leg of the stool, or of course, if you happen to have a pension still, you can, that's that leg of the stool, and you're taking care of. Third leg of the stool then is Social Security.
Yes, as an RSSA, I'm focused all the time to make sure that people maximize that Social Security income benefit. And also, a lot of couples can do a lot of different things with their Social Security and turn on different income at different times between their own income and also spousal income as well.
Well, I want to dive into some of what we've been talking about a little bit more, that the whole personal pension aspect of it. We'll talk also more about Social Security before we're done today. So stick around, folks. We got much more retirement results, that and more, just ahead.
Scan the QR code on the screen with your smartphone to visit retirementresults.com/plan. That's retirementresults.com/plan. Our team is standing by and ready to start building your successful retirement plan today.
Welcome back to Retirement Results with Ford Stokes. I'm Matt McClure here alongside Ford, and we've been talking about the importance of having your own retirement income plan. Part of that we just talked about is part of the three-legged stool of retirement, Ford, is Social Security. And we were talking about the number of decisions that go into Social Security. People might be surprised to know there are some 2,000 some odd decisions to be made when it comes to Social Security.
Yeah, a lot of people think, hey, you know what, if I can just make one decision, whether to turn it on or not. Believe it or not, there's a lot more decisions, especially with a married couple, or let's say you're a divorced spouse or a widowed spouse. We're absolutely going to be able to help you make some of those really sound decisions on when to take Social Security income. But there are a lot of decision points within that. I will also just tell you, you've got to be careful too about how much pressure you put, downward pressure on withdrawals from your own retirement nest egg. And sometimes turning on Social Security a little bit earlier may help you. But obviously, the longer you wait, the more you're going to make with Social Security. And I would recommend people plan to have Social Security be around even after 2033, like we talked about with the Old Age Survivors Insurance Trust Fund going away by 2033, unless Congress does something different. Chances are Social Security will be around, but it may not be in the same form it's in now. And it may be at a 23% level lower. But anyway, I just want to make sure that everybody understands there are a lot of decisions to be made within Social Security, and you owe it to yourself to go ahead and call the number on the screen just to get a free report, get that RSSA roadmap to really figure out how you can maximize your Social Security income.
Yeah, absolutely. And of course, throughout the show today, our viewers have been seeing the number on the screen, also the QR code there as well. You can scan that. It'll take you directly to our website. It's like a scan for your plan sort of a thing.
That's right. I like that. I like that.
I like anything that rhymes. Alliteration and rhyming, you got me.
That's right.
Well, and that was just one of the two. I know what alliteration is, folks. Don't come for me on that.
Right.
But I want to go back as well to something that you talked about in the previous segment. We just kind of mentioned it and kind of grazed the surface a little bit. But we were talking about annuities, and specifically annuities as bond replacement. About, they talked about the old 60-40 portfolio, 40% bonds, 60% stocks. Well, now the kind of new 60-40, at least as we think about it at Active Wealth Management, is 60% stocks, 40% fixed indexed annuities. Why is that advantageous for our viewers?
There's several reasons why taking the 40% income portion of your portfolio and moving that into fixed indexed annuities are advantageous for clients. Number one is you're going to delete the advisory and portfolio fees from that portion of your portfolio. So let's say you got $1 million portfolio and you got $400,000 sitting there in your income portion of your portfolio. It's just $1 million IRA, which is typical for a lot of people, especially the hardworking people within our community. Let's say you take the $400,000 and you take the advisory fees away, and a typical advisor portfolio fee is about 1.5%. You're going to save $6,000 a year. Now, our fees are lower than that, but you're still going to save, and you're going to go to zero with that amount of your portfolio. So you're going to save money there. The next thing is you're going to protect the nest egg that is the income portion of your portfolio, where you cannot lose that principal. That is incredibly important. And then the third is you're going to have increasing income if you're tied to a fixed index annuity as you age, and also as that index improves, you get a participation rate in how that index performs. So if you want increasing income that can also keep pace with inflation, replacing the bonds within your portfolio with a fixed index annuity is huge. Last big piece, and it's more of a negative to the bond side, Matt, but bonds represent interest rate risk and also reinvestment risk. You don't have the same problems with bonds that you do with fixed index annuities. With bonds, you're looking at serious interest rate risk, as we've seen over the last 3 years. In fact, the last 3 years of the 60/40 portfolio are the worst 3 years in the history of the 60/40 portfolio, excuse me, that literally is a 70-year-old strategy.
Yeah.
It's time for a new one.
Yeah, absolutely. And I think that that is something that our viewers can grab onto as well. Really does speak to, controlling what you can control and making the changes that you need to make your retirement successful, and working with a team of experts who can really get you there, right? And the bottom line of all of our discussions here today and on every show that we present to you, our viewers, is that we don't want people to live kind of a just-in-case retirement. We want people to live the retirement lifestyle that they have always dreamed of, that smart vision for their retirement that we talked about earlier. Enjoy establishing that solid income stream that has both paychecks and playchecks as part of the mix.
Yeah, it's super fantastic. Those terms come from Tom Hegney. He's one of my retirement heroes. In our family, Matt, we spell love, Time. We want to give our clients the ability to spend more time with their family and friends. And sometimes that comes with money. A lot of our clients, they try to get on the lake, or they try to get a place at the beach in the panhandle of Florida, or even further south in Florida. They really want to plan for their retirement so that their kids and their grandkids will come see them.
Yeah.
And so we want to help them build an overall plan that'll work. And we do all that on the front end. So we give you an incredible opportunity to see your entire financial plan to your 95th birthday. And here's what people get when they come see us, Matt. Number one is they get a Social Security maximization report. Number two is they get a retirement income plan. That's a pretty important one, so they can understand whether they have a retirement income surplus or a negative retirement income gap. The third thing we give them is a financial plan to their 95th birthday. Absolutely has nothing to do with us. It's their current plan. The fourth one is we'll give them a retirement plan all the way to their 95th birthday with our recommended portfolios. And the fifth one, and this is really important, we're going to help them delete the IRS from their retirement accounts with a retirement plan to their 95th birthday that includes a strategic Roth ladder conversion plan that minimizes the taxes they will pay over their 30-plus year retirement.
And folks, if you think that any of this sounds like something that you are interested in, we would encourage you to scan the QR code on your screen right now, call the number that's also on your screen, or go to retirementresults.com. You can sign up for a free, no obligation consultation. Well, stick around. We've got another segment coming up of the show. I'm not quite done with you just yet. We're going to welcome in Sam Davis, who is going to lead us in our favorite financial game show, and soon to be yours as well. It's called Right or Wrong. Stick around. Welcome back to Retirement Results. I'm Matt McClure here with Ford Stokes. And now we're joined by Sam Davis. He's going to lead us in another edition of our favorite game show, everyone's favorite financial game show, Testing Your Financial Knowledge with Right or Wrong. So, Sam.
First off, so great to be with both of you this morning. Happy to have our audience watching. And this is a great segment if you're confused about anything regarding retirement. Right or Wrong really helps clear up a lot of those misconceptions. So, Ford, the first one's for you. Is this right or wrong? Your Social Security income benefit stays the same throughout your retirement.
Well, fortunately, that's wrong, because with cost of living adjustments that come from the Social Security Administration, your income from Social Security should increase over time. Also, Sam, I just want to say thanks so much for being the executive producer of our radio show, Retirement Results, for over 5 years. We're now on television. We're all grows up here. That's pretty good stuff. But it's also great to have you as a licensed financial advisor with Active Wealth Management.
Well, really appreciate it. Matt, this next one's coming for you, and this one's concerning. So the Old Age and Survivors Insurance Trust Fund is projected to be depleted by 2033. Would that result in a 23% cut across the board? Is this right or wrong?
That is unfortunately right. The Office of Management and Budget and the CBO, the Congressional Budget Office, projecting now that the OASI, as you just said, will be 100% depleted by the year 2033, just 9 years from now. And that, of course, is unless Congress acts and does something. And we really hope that they do.
Yeah, very concerning. Hopefully the people in Washington, D.C. can balance the budget. A lot of retirees depending on that. Ford, one more for you. Is this right or wrong? People can actually establish their own personal pension and receive a 20% bonus on their money and 8% interest per year every year they defer withdrawals.
Well, I've got great news. That is right. We have access to incredible products from insurance and annuity companies that offer those types of bonuses, up to 25% bonuses, also including an 8% simple interest guaranteed on the premium that you invest into that fixed index annuity. It's also, as Matt and I've talked about on the show today, it's a great bond replacement to really generate that income you need in retirement. But let's say your portfolio lost a little bit of money in 2022, or let's say you really didn't do well in 2008 and 2009, like so many people did when the S&P 500 lost 50.1% of its value between March 08 and March 09. That 20% bonus can really backfill for that retirement account and that retirement income account, so you can really enjoy more of your retirement and hopefully outpace the expenses during your retirement.
Well, that's great news for all the retirees out there. And we know the people we work with enjoy how much easier that makes it to plan their future retirement.
Well, Sam, thank you so much for joining us and leading us in another edition of Right or Wrong. And I will echo what Ford said as well. It's great to have you as part of the team as a licensed financial advisor and life and health agent as well.
Yeah, well, so happy to be here, hoping to educate all of you out there watching and listening and how to build a more successful retirement.
And as a viewer of the show here, Retirement Results, you can get your Results in Advance retirement plan specifically built for you from the Active Wealth Management team. All you have to do is scan the QR code on your screen right now. You can also call the number that's there on the screen or go to retirementresults.com. Thanks so much for joining us. For Ford Stokes and Sam Davis, I'm Matt McClure. Really appreciate you being a part of Retirement Results, and we will see you next time.
Scan the QR code on the screen with your smartphone to visit retirementresults.com/plan. That's retirementresults.com/plan. Our team is standing by and ready to start building your successful retirement plan today.
Ford Stokes and Active Wealth Management are not affiliated with or endorsed by the Social Security Administration or any other government agency. Information provided is not intended as tax or legal advice and should not be relied on as such. You're encouraged to seek tax or legal advice from an independent professional. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims-paying ability of the issuing company and are not offered by Brookstone. Any bonuses mentioned may be subject to additional restrictions and regulations based on the offering annuity company. You may not receive the bonuses if the contract is fully surrendered or if traditional annuitization payments are taken. And if the policy is partially surrendered, it could result in a partial loss of bonuses. Because these are bonus annuities that may include higher surrender charges, longer surrender charge periods, lower caps, higher spreads, or other restrictions that are not included in similar annuities that don't offer a bonus feature.